Well, from view from the chair to things that should make the chair nervous with cybersecurity and ensuring world trade. David, lead us off. I think you're coming up on stage with the panel, and then we're going to play the video from Brian.
Good afternoon, everyone. I'm Brian Billendorf. I'm the Chief AI Strategist for the Linux Foundation, an industry consortium that works with 3,000 global organizations and government institutions to coordinate the development of nearly $50 billion in open source software IP, open specifications, and other open systems that underpin 70 to 90% of the software inside every device and within or behind every app or website. We are also home to global efforts to address cybersecurity gaps in open source software and in the software supply chain, in addition to software driving the development of most of the AI models and systems in use in production today. The threats from traditional cybersecurity attacks to global trade and industry has escalated to new levels. In just one example last week, hospitals across Ontario, Canada were crippled by a ransomware attack that shut down critical services and left other parts scrambling for paper-based records and scheduling. The hospital network CEO said it will take weeks to recover. Imagine not just the revenue lost and incredible expenses incurred, but the human cost of delayed procedures and exams. The WEF's Global Risk Report for 2023, as all previous risk reports, included cyber in its top 10 risks, specifically stating, alongside a rise in cybercrime, attempts to disrupt critical technology-enabled resources and services will become more common, with attacks anticipated against agriculture and water, financial systems, public security, transport, energy, and domestic space-based and undersea communications infrastructure. There is no longer a separation between cybersecurity risks and other kinds of macro risks. To paraphrase Mark Andreessen, software has eaten risk. Furthermore, our international data networks are vulnerable to attack in pervasive and obscure ways. The SolarWinds breach, which compromised many government and military systems, and the Log4Shell vulnerability, which left everyone from the banking sector to Apple's App Store open to attack, demonstrate that there are flaws in the software supply chain that need repair. Governments have spent the last few years responding in depth. In 2021, the Biden administration launched the Critical Infrastructure Security Agency, which has been incredibly active in engaging the private sector in hardening public and private systems and approaches. In Europe, the European Union is finalizing legislation that calls for more liability for cybersecurity breaches to be placed on the builders of technology, rather than just leaving it as a risk for the end user to accept. Artificial intelligence tools are now being used by attackers to drive new kinds of attacks, both technological in the form of compromises and social in the form of misinformation that can drive civil unrest. AI makes it trivial to come up with spam that looks and feels more human than spam ever did before. These can be used not just to drive angst and anxiety on social networks or to get somebody to click on a link in an email. They can further social engineering attacks at all layers of the corporate stack and even upon consumers. These are systematic threats that undermine organizations and institutions in uneven and unpredictable ways, which from an outsider's point of view would seem to make them ideal for an insurance industry to tackle. However, many of these threats have high correlation. Nearly every enterprise was affected by the Log4Shell breach as soon as it happened, for instance. And it seems difficult to price the risk of ransomware attacks when even those organizations with well-run IT teams seem to be vulnerable. And yet, while it might not seem obvious, there's even more that the insurance industry, including reinsurers, can do to address these systemic harms than they can even upon something like climate change. Climate change interventions, such as reducing carbon in the atmosphere, will take decades to pay off. But cybersecurity and AI-derived threats can be mitigated with much more short-term payoff. As an example, Log4Shell. When that happened, more than half of the affected sites globally were updated within weeks. More importantly, that attack drove adoption amongst the software infrastructure community, particularly in the cloud, of the need for greater provenance tracking and traceability, using a range of tools such as software bills of material and digital signatures on software artifacts. The tech industry is investing in these tools, and governments are assisting in their adoption, but the insurance industry could play an outsized role in driving adoption and mitigating these harms if they based cybersecurity insurance premiums on the adoption of these technologies. What would the value to society be, and to the industry all of you represent, if the next Log4Shell breach were averted? As just another example, Much of the AI software in use today is open source software. And while much of the data feeding those models is not open source, much of the software used to compile those models is. This open source software is an ideal place to insert guardrails for protection against bias, unethical content, and detection of attempts to use the models to further nefarious activity. There are a few open source software efforts today, including some hosted here at the Linux Foundation, and another developed by the Singapore government called AI Verify, that can address these concerns. But they are still at early stages and not yet widely adopted. I believe we are living through what it's like when everybody agrees on the need for something, but we all invest separately and poorly when we all could combine forces to create something production quality and compelling. These kinds of efforts require investment, but they produce public goods that anybody and everybody can benefit from. As they prove themselves to be production ready, they can be worked into the default platforms and systems everybody uses. This is how Linux worked its way into billions of devices shipping every year. It's not enough to leave it up to the big tech platforms to invest in these public goods as the ones who are more incented to move fast and break things, so to speak. Sure, governments are starting to open grants for this work too, but as the ones who ultimately bear the costs of large breaches and disasters, it's the providers of cybersecurity insurance who have a very large incentive to see the right outcomes here. And reinsurance companies as well, who can see these same sorts of systemic threats and costs as they do with climate change or other global issues. The financial services sector was among the first to recognize how combining efforts on common open source software could drive innovation and manage down risk at the same time. Industries like automotive, telco, and energy have followed suit. There's huge upside for the insurance sector to similarly seize the opportunity. Thank you and have a great event.
Well, thank you very much, Brian. He's one of the great pioneers of the web. He founded Apache and Mozilla, and now he's really taking forward the open source issues of cybersecurity. So most things are going to be built of open source. The AI, the generative AI, will all be part of open source. So these are systemic global risks. So cybersecurity it's an equal opportunity risk. It's also a dynamic risk, and it needs a dynamic response from the insurance industry. So if we just very quickly take what Brian has said here, but we had the father of the internet also addressing the IIS a few years back, and he said that when the internet was founded, it was founded for academics and to do a re-civilization if there was a nuclear attack. There was no security layer at all on the internet. So we had to wrap it with a lie detector for data in order to make the internet tell the truth, if you like. So that meant you had to have data integrity and cyber integrity. And it's the cyber and data integrity that needs to be taken to the board level. And one of the discussions of this conference is, data as an asset at the board level. Well, the cyber needs to come to the board level with it. It's not an IT issue. And the more that we digitize, the more this becomes important. To tie it to the theme of this conference, which is world trade and ensuring world trade, the panel here is going to discuss, the issues of world trade, the relevance of insurance to that, and some of the threats, systemic risk as we go through. So, before I introduce the panel, just to set the scene, the world is becoming fragmented because of the polycrisis that we've been discussing here. So world trade is going down, the world is fragmented, there's national, protectionism, and that's opening a lot more security holes, both physical, hence wars, and cyber virtual attacks. So the more that we have this polycrisis, the more holes will open for cybersecurity. So it's very important that we move to a reglobalization at some point, and that reglobalization is going to be technology-led. So unless we have the mitigation in place, we won't get that reglobalization. So I'd like to introduce our excellent panel here. On my left is Peggy Chow. She is the data and cyber lawyer for Southeast Asia and China, Greater China, for Herbert Smith Freehills lawyers here in Singapore. Adam Peckman, he is the global head of global cyber consulting for Aon, and also the head of Aon in Asia Pacific. He's working very closely with analytics for cyber. And the third panelist is Steve Tunstall. Steve is a co-founder and general secretary of the Pan Asia Pacific Risk Management Association. He's the closest one to the customer. He sees customers all the time, and Steve himself has been a chief risk officer, captive manager. And we're going to start off with Steve and ask him how he perceives the customer is looking at cybersecurity these days and what's on the market for insurance.
Thanks very much, David, and great to be with you this afternoon. Thank you. Yeah, so I've worked in-house and outside for big conglomerates in Asia for 25 years now, and I've seen a lot of things in the roles that I've had. And I think you already touched a little bit the way the unipolar world is unwinding into a multipolar world is a huge issue for risk managers, and there's a lot to think about as we unwrap that from a cyber perspective. In particular, I think one of the aspects that I don't see a lot of where the dots are joined on this is the fact that, I read a lot of publications by the Institute for the Study of War, International Institute of Strategic Studies, people like that, and there's a huge amount going on with the weaponization of cyber, particularly in a military context for countries, not only in Asia as elsewhere as well, that I just don't see a lot of commentary on that about how that might impact on corporates. And I'm not talking about silver-colored men with M16s saying I'll be back. It's not like that these days. It's a very different approach, and that weaponization is invisible. And you asked us to think about how that impacts broadly on things like ports and infrastructure and things like that. And quite frankly, as a lot of the military targets become hardened and better able to defend themselves, well, what's going to happen? The AI is going to point itself at what's the civilian target next door. So if you have a military port and there's a civilian port right next door to that, well, how do I block the seaway? Well, let's target the port instead of the hard challenge. And I think that side of things is particularly, a lot of companies in Asia in particular are not aware of those potential implications and how soon they could come about. And I think that's an issue now, never mind in the future. So I think civilian infrastructure is definitely a potential proxy for those sorts of actions, which are potentially untraceable. I'll give a specific example of some of the things that seem to have happened that we don't have clear explanations of, and just one specific case study. Again, you asked about freight and sea freight, and we all know a couple of years ago the incident where the vessel, the Ever Given, managed to block the Suez Canal. I keep reading about that, and I'm still reading about that recently, trying to work out what actually happened there. And the general opinion is that an overwhelming 40 mile per hour wind blew the vessel around. So for any NatCat specialists in the room, you now know that 40 miles per hour is overwhelming. So please make a note of that if you didn't know it before. And then, surprise, surprise, the captain, an Asian captain who'd been in charge of ships of this size, and these are huge vessels, for 20 years, he apparently decided to do a U-turn in the middle of the Suez Canal, and we're all supposed to accept that was a conscious choice on his part, and that he's the one at fault in all this. For me, I suspect much more likely there's something gone on there with a cyber perspective that we just don't see in the reports. Of course, being a risk manager, I'm one step away from a conspiracy theorist, so who knows whether this is right or not. But But these are the sorts of things that I think we're increasingly going to see issues like this in the future.
Just to follow up quickly, I think what's very concerning is that the ports are all underinsured. The ports were digitized during the pandemic. They have no standalone cyber policies. The ship owners are not buying any insurance at all. They rely on the P&I clubs, which exclude cyber. So what do you think about this kind of critical infrastructure being uninsured around trade? I mean, your members talking to you about this?
Yeah, I mean, well, I'll maybe come back and talk a bit more about cyber insurance specifically later, but in terms of the customer perspective, I really think there's still a long journey with a lot of corporations, particularly in Asia. They still have a lot to think about on this, and it's a fast-changing field, and I think boards are, we heard on the last panel, you need to be able to present to boards in a way that boards can take on and then deal with the issues that are being raised. And I think a lot of times in Asia, in particular, from what I've seen, that journey is still a work in progress.
Right. So I think the audience should know that the House of Lords in England said that if the London Gateway was cyber attacked as a port, the UK will be out of food in 3 days. So there's a massive food security. Now, in China, coming to you, Peggy.
Yes.
All the 10 of the top ports are all in Asia, or in Dubai, in the Asia region, right? 10 of the top ports, and 90% of goods go by sea. So this port and world trade is high, and lack of insurance is highly connected. So Peggy, you're working with the data, the cyber regulations, and can you give us some perspective on the regulatory landscape?
Yeah, sure. Before that, I just want to point out that cybersecurity definitely is a very, very relevant topic for the insurance industry, because insurance is all about managing risk. And based on our discussions with our clients, cybersecurity is definitely on the top of the risk portfolio, and it's the topic which keeps board members up at night. So if insurer can help organizations manage that risk, that would be very useful and helpful. In terms of cybersecurity and data regulations, in Asia, when we talk about China or a lot of other countries in Southeast Asia, including Singapore, there are hard laws and soft laws. So in terms of hard laws, the Cybersecurity Acts or the cybersecurity law in China, I think that the core principle is that for critical infrastructure players, CIOs, they are required to take security assessments and have their core IT systems approved by the regulators. So this is kind of like a mandatory requirement imposed on all the critical infrastructure players. And on top of that, of course, there are mandatory cyber incident notification requirements, data breach requirements. On the other hand, there are some soft laws helping organizations to assess their cybersecurity risks. So, for example, in Singapore, the cybersecurity agency have rolled out this cyber trust mark campaign. So any organization may apply for this if they have taken robust measures to ensure that their systems, their cybersecurity measures are up to standard. Personally, I think this could be used as kind of like an objective third-party standard for insurers to help them to assess whether a company is fit for taking cybersecurity insurance policies. Because I think one of the concerns of most cyber insurers is they don't have visibility as to how robust the cybersecurity practice of an organization is. So my view is that if there are more of this type, industry objective certification program, they may help the insurance industry to assess the cyber preparedness of a client. In terms of data laws, I think data law is important because a lot of the cyber attacks, ransomware attacks, ultimately, what the hackers trying to achieve is to, hack the data leakage. They use this as a threat to require ransom, to demand ransom from the victims. And in terms of cyber data governance, the core principles would be around data security, data retention, data security measures, as well as data quality. So this is, kind of like the core principles under data privacy laws, but also under, laws governing non-personal data. So overall, organizations, in order to, to be better, prepared, for, as a healthy organization, cyber resilience, they will need to look at their data pools to ensure that, for example, if data is too old, there should be a way, to manage that. Either they destroy the data or the data should be masked and archived. I know a lot of organizations actually have very old IT systems. There are multiple systems. They don't even understand how the data is stored and where the data is stored. So in terms of laws and regulations, in terms of data compliance, there will be obligations for organizations to have a good understanding of how data is used and stored within the organization. This is the principle linked to accountability and privacy by default or privacy by design principles, which are kind of the new trend under data privacy laws. So in the past, it's more on compliance, but nowadays, all the regulators are looking at accountability.
So is it fair to say that the data is improving in Asia and that boards of directors are taking more attention to data? Is that true or false?
Yeah, I would say, like, in terms of regulatory landscape, is getting more complicated in Asia because most jurisdictions in Asia have their own, data privacy laws. They have also, enacted a cybersecurity law to deal with critical data and important data. In terms of awareness, among organizations in Asia, I would say, definitely, organizations are recognizing that, data integrity, data governance is a key issue. So, overall, I think it's definitely the trend, but I think the tricky issue is, is very difficult. It's a very time-consuming and resource-intensive exercise.
Thank you. Right, Adam, you're in the hot seat. The mismatch between the insurance industry and the customer in cyber is obviously quite large. Could you address that comment?
Sure. Thank you for having me along. I'll just pick you up on the introduction. I head up the cyber business in Asia Pacific, not the entirety of the Aon business, just in case Anne's still in the room. I don't want to think I'm gunning for a job. Look, it's good hearing what the other panelists describe as some of the challenges. I think I certainly wouldn't suggest that there isn't a significant protection gap or capital efficiency gap when we think about cyber. There's, depending on what time of the year, there's probably about 13 billion in premium out there, growing at a considerable rate for cyber insurance. But if you look at the 4 trillion in losses, obviously it's that far outshadows the amount of premium that's getting pumped into the market. So there is a significant material capital protection gap out there. So there's still a way to go. And some of that is both within the corporations themselves, and some of that is a product of the market. So the first is, and you'll hear, if anyone's heard Greg Case talk about cyber, he often refers to it as a distributed problem, and distributed within the companies themselves. There's no single owner of cyber risk. And because of that, it obviously creates challenges around who's making a decision around, the importance, the materiality, and how capital is best deployed to manage that risk. So, you've got CISOs, general counsel, people in an operational capacity, IT staff, and then you've got risk and insurance. Everyone is still coming at it in a very different way. Is that scratching against my beard? Is that picking up? So because of that distributed nature of the problem, I think that it does create a lot of a time lag in terms of any decision making. I think the other part in terms of our pace is people experimenting with AI and people thinking about new forms of technology and business models within these companies are quite often moving 3 years ahead of business as usual, whilst risk and insurance is quite often thought about in terms of 3-year, long-term agreements around programs, and the frequency or the cadence around which those changes are made don't match, that digital frontier within the organisation. So I think there's a degree by which there's a time lag effect where people are out there experimenting and deploying new technology, creating new business models, disrupting industry, and the insurance decision-making probably doesn't keep pace to that. So those are two aspects. I think the last is to go back to the insurance industry and perhaps, looking within. We still look at things on through a lines of business paradigm. If you speak to a CISO about security, they're not thinking about trying to disarticulate a cyber risk from an IP risk, from an AI risk, from a digital asset risk, from something around ports in terms of OT bricking. They think about it just as a cyber issue in terms of, the breadth of potential downstream consequences. So I think they're, being anchored by lines of business and looking through, these, challenges through a lines of business paradigm, I think can probably, hold us back from some of that innovation. But I would also match that with, to the point of this conference, the value creation. When we look at companies' claims performance and the claims performance in the industry, there is a negative correlation between the slow maturation of the industry as a whole and the downtrending in claims and loss volatility. So I think there's something there that we could speak to in terms of the value creation. Equally, in terms of just improving capital allocation around cyber risk, I think it's a great forcing mechanism to go through the process of putting the insurance in place, because then a lot of focus becomes around, if we are able to disarticulate ourselves from the rest of the market, we can actually see improvements in the product in terms of coverage, in terms of capacity, in terms of pricing. So I think, there we can see that, there really is capital efficiencies that can be brought. I think to the point of the earlier panel on the view from the chair, I think the improvements around modelling risks have helped contextualise risk through the lens of business impact, as opposed to it being a very nuanced and technical conversation, which perhaps an exco or board couldn't necessarily get their arms around. With the modelling capabilities that insurance have, the insurance industry has been able to bring to this topic, you understand volatility, you understand balance sheet impact. That is a data point that a board or an exco can move more swiftly toward. So I think, those parts. And lastly, just there aren't many controls that a CISO can invest in that can shift $100 million off the balance sheet like a capital hedge such as an insurance product can. So I think it does play a significant role in the overall resiliency framework when you think about how do you manage cyber risk. So again, there's a capital efficiency play. When we look at brand valuation and erosion of capital shareholder value post-cyber event, those that don't manage it well, that don't have insurance in place, tend to suffer, 7 to 22% shareholder value loss. Those that have actually been through the process, the diligence process, put in place cyber insurance and so forth, fare far better. So, look, work to be done to bridge that capital protection gap, work to be done to be more, to speed to market of new innovation. But I think, insurance, the cyber insurance industry has definitely created a lot of value in this particular domain.
Well, let's tease down a little bit more on that, on the side of the second round of questions. We'll start with you, Adam, on, I think the reinsurers are thinking very differently to the insurers when it comes to cyber risk. There's 50% being ceded right now. They're mostly quota share, but the reinsurers don't want to pick up the tail, and they're moving a very different direction. Do you think the capital is going to flee the traditional cyber market with the reinsurers in this mode of thinking?
I'm pretty bullish in terms of the capital still coming into the insurance market. Not only the traditional reinsurance capital, which we still see growth and a lot of a growth stance by the bigger players in the space, but also the flow of alternative capital into this space as well. Beazley putting in place an alternative structure to unlock more capacity for retail distribution. Hanover Re putting in place an alternative structure. So I think we'll start to see, and definitely within our securities business, we're quite bullish around thinking about the emergence of more IIS solutions for the cyber insurance market. So I think it's all quite positive in this space. We're seeing an uptick in cyber losses this year to match 21. We saw a dip in 22. What that will mean in terms of the future interest of some of these alternative capital players, we'll have to wait and see. But I think the fact that a Beazley were able to put in place that type of cat bond that they were able to structure demonstrates that, at least for the market as a whole, you had institutional investors taking a view that the diligence and the modelling was sufficiently sophisticated, and that there is we're sort of reaching the second S curve within the cyber insurance market, and I think that with that maturation will continue to unlock capacity there that will be able to be brought to hopefully increasing the amount of people accessing direct insurance.
I'll ask Steve a question in a minute on that, but before we do that, Peggy, the biggest problem with cyber to most organisations is the interconnectivity of risk. It's a big increase in interconnectivity, and now we have AI and we have quantum computing as well. This adds another level of interconnectivity of risk. You know quite a bit about the effect of AI on cyber, and maybe some of the generative AI is writing better malware at the moment than it is writing other things. So what's your view on this?
Yeah, my view is AI is a tool, right? So it can be used by cyber criminals. It can also be used by cyber insurance companies to help them manage the risk. So in terms of how AI can be used by cyber criminals, I think there are a number of ways. Typically, for example, for machine learning algorithms, the cyber criminals may be using the technology to crack passwords, or to analyze user behavior so that they can locate vulnerabilities in the systems. Another way of using AI is to help them to draft phishing emails. Because if you remember Cybersecurity Course 101, one of the giveaway is that most of the phishing emails would contain poor grammars, typos, or just bad drafting. But definitely, the cyber criminals can make use of these generative AI tools to help them draft better phishing emails. Another use of AI is deepfakes. So deepfake means that the AI can help you create images or videos which may help the bad actors, the threat actors, to impersonate certain individuals, making people falling into scamming exercise, etc. And finally, sophisticated cyber criminals, they may be using AI, to help them to automate the process. So meaning that they may use AI to scan the systems of potential victims, to locate vulnerabilities, and they could exploit that vulnerability. So there are a lot of ways that AI can be used by cyber criminals. But on the other hand, cyber insurance companies or organizations can also use AI to help them to detect abnormal activities in their systems, to detect abnormal data flows. So I would say I think ultimately it depends on which side can use AI in a better way and how well they can deploy the technology.
So thank you. So Steve, listening to what Adam just said, there may be a view that a lot of cyber risk like the attritional risk, will move to captives, and the bigger risks will move to the capital markets, and the traditional market might actually not get a say anymore if they don't change the products to be more fit for purpose. Does that come to a view with you?
Yeah, I think that's some very good points there, David. And I think firstly, I should probably give a trigger warning if there are any cyber underwriters of a sensitive disposition. Now is probably a good time to go for a bathroom break, because probably what I'm going to say next is not going to be very attractive to a lot of you. So in preparation for this event, I took several perspectives from members of Perima and from a group of CISOs who I'm a member of a chat group with them. And I think the feedback I'm going to give is probably not so good for large corporates who are buying cyber, but I do see some silver linings. I think there's some real silver linings for smaller companies buying cyber insurance. But I spoke to 5 CISOs in preparation for the event who are leading large teams for some of the largest banks in Asia, and in a couple of cases, 2 of the largest tech companies in Asia. And I asked them all the same thing. Well, what's the relevance of cyber insurance to you, and how can we add to the value? And quite bluntly, 3 of the CISOs said insurance is irrelevant to them, completely disinterested, and saw no purpose to it. The 4th CISO told me that insurance is irrelevant to him, but then I was in the pub with him at the time. He's a Russian guy, and we spent the next hour while he explained in great detail why insurance is irrelevant to me, and drank quite a bit of strong water. That's an hour I won't get back, because he was sort of blaming me for creating a risk management association, because his risk committee is telling him to buy cyber insurance, and he's actually fighting them constantly and buying the minimum limits that he can, because he really believes it's quite irrelevant. The 5th guy, who's the head of security for a very large tech company here in Southeast Asia, he has a slightly different perspective. And to paraphrase Douglas Adams, he was saying it's mostly irrelevant. But he's got one box that he really likes to use cyber insurance for, and that's his ransomware. So basically, he buys capacity about 20-30 million, and he uses that in the event that there's a ransomware type attack. He can then ring fence that out of the rest of his budget, so he doesn't have to deal with it. But it's probably only 5% of his budget overall, and he just uses it as something to put in the corner. I also went and talked to 5 risk managers of very large companies in Asia who are headquartered in Asia. And the risk managers often, as you said, it's this distributed problem in companies where they end up as the communication channel for the insurance sector to the rest of the business. And again, I'll go through this quite quickly because it doesn't make pleasant reading. But the risk managers are saying there's a gradual disappearance of relevancy of many commercial carriers, reduced capacity, massive volatility of pricing. Many insureds experienced a doubling of the cost of their cyber insurance last year. It's come back down again this year, but that puts huge pressure on budgeting in client companies when that happens, and doesn't show a lot of loyalty, quite frankly, from the insurance sector. And there's a huge number of scope restrictions in all cyber policies these days. Insurers generally have shown a lack of investment in developing their understanding of cyber risk. There's very few cases where insurers have really good risk engineering and loss prevention expertise, especially when you compare it to something like PDBI. This is reaching the point where some risk managers are saying to me that they actually won't take the insurers to meet their technology team because they just can't talk to each other. They're unable to communicate effectively in the same language. This does lead to what you were saying, David, about there's much more likelihood of these risks being part of a captive or part of, in Europe, I think we're moving quite quickly to mutual funds for cyber, mostly because the insurance industry has not responded to these large clients and their high-level needs. Some risk managers are saying, well, perhaps this probably is a point of no return for large corporates buying cyber. The scope and the capacity is just not there. And I have to say, it is something I feel that we've had a sort of false dawn every year for 20 years now with cyber insurance, and that we're saying one day it's going to get really good for big corporates, but I don't know when that one day is going to be. I think for smaller insureds, SMEs, particularly larger SMEs, I think cyber as a product has got a huge amount of potential, mostly because a lot of those companies don't have CISOs, they don't have good cyber defense teams. So when they do end up in a crisis, I think insurance with its additional adds-on of crisis management support, things like that will be very helpful to many of those mid-sized companies. But as I say, in summary, the bad news from the message back from the biggest buyers of insurance in Asia is that the insurance industry is just not responding.
Well, I think the provenance of data, as we've discussed, I mean, Adam, there's a world of opportunity for new touch points for insurance in world trade, in supply chain touch points on digitized. There's a lot of intangible assets that have never been touched, never been insured out there. Maybe parametric insurance will get rid of exclusions that are upsetting people. I mean, exclusions are upsetting the customers. But how do you see the parametrics or new products?
Well, certainly on AI and digital assets in the IP space, I think any of those intangible assets, I think that there's still an evolution there in terms of how we think about, as opposed to make clients make decisions on a very discrete basis around how they break up their risk registers and try to map them to, like I said, different discrete lines of business, as opposed to try to think about it in a more expansive way to match the needs of our clients. I think there's still absolutely work to be done. I think even just clients still expanding upon what they have in their current programs. I think, still a minority of clients are doing, any type of financial modeling around their cyber risk profile. And that goes a long way to the challenges that Steve referenced as we try to explain what the value is of cyber insurance to a CISO, as an example. I think my observation would be that CISOs have actually turned a corner in looking at the purchasing of cyber insurance as in some way an either-or proposition as to whether they get budget. And so I guess my experience has been that more CISOs are moving closer to understand the nuance around what's going to make a difference within affecting a better outcome for their client in terms of their business, in terms of buying cyber insurance, and then trying to understand how they can frame the return on investment within what they do in a broader context. How does that mean their claims experience is better? How does that mean that they can improve capacity coverage or rates because they've brought online new capabilities, matured in areas that insurers have pointed out they needed to, and actually use that as a reference point back to the exco, back to the board to demonstrate value add. So I think it probably depends on the segment in which you're talking. I think that there's probably a lot of misreporting within some of those CISO circles as to cyber insurance, how responsive it's been to some of the large claims that we've seen historically, where it actually was a cyber claim under a property policy, not an affirmative cyber insurance policy. And so because of that, that makes its way on LinkedIn, that gets discussed within forums that maybe don't have a background in insurance, and then the takeaway is cyber insurance doesn't respond. Look at that. Mm-hmm. So I think there's still work there in terms of communicating value to those particular position holders. So I wouldn't, and look, the protection gap is what it is. So I wouldn't say that we've achieved the end state yet there. But I think, in terms of innovative use of products, particularly around digital assets, AI, rep risk, I think, that definitely has a big role to play there as well.
Yeah, and I think the policy wordings and exclusions is something that interests. I mean, in the ship owners, as I said earlier, ship owners don't buy insurance, cyber insurance. They want bespoke insurance, but they just won't buy the current. So they rely on the P&I club for their insurance, and the P&I clubs exclude cyber. So this is a vicious circle. So the policy wordings need to change. Yeah.
I just want to echo what Steve and Adam have shared. So as a cyber lawyers, I do go and see our clients. We ask them how they are managing cybersecurity risk within the organization. So cybersecurity is usually one of the topics that we will touch upon. In terms of our clients, like that include big tech companies, conglomerates based in Asia, hotel chain operating globally, as well as financial institutions. So the feedback from our clients is that for those who have purchased cyber insurance, the major complaints will be around the increasing premiums and a lot of additional exclusions. So they are like constantly evaluating whether it's worth buying insurance if that insurance actually cannot cover the risk. So for example, like some of our clients have shared with us that the insurance company is actually trying to include ransomware as one of the exclusions. So they won't be able to claim for ransom which have been paid to threat actors. So I think definitely there's something that the insurance industry needs to think about, because if everything is excluded, then what would remain insured under the policy? Another interesting point brought by one of our clients is that there are a variety of insurance policies, because that would increase the visibility among threat actors, because they believe that the threat actors will have a list of companies which have bought cyber insurance, and they believe that these threat actors actually would target those who are on the list. And in terms of the ransomware that they demand from the organizations, it would be like nicely, just below the insurance cap that these organizations are covered. So from the customer's perspective, definitely there are a lot of concerns among companies in buying insurance. Finally, I think my observation is cyber insurance actually is quite a hot topic within the organization, like to be resolved by CISO, legal, and the board. And their stance towards cybersecurity actually changes over time. And what I understand is most of them would review their cybersecurity insurance policy every year, and they may be changing their thinking around cyber insurance. So I think, in terms of what the industry should react, definitely there's a need for them to talk to the clients to understand their needs, and then I understand a lot of insurance players. If they find it difficult to assess the risk involved by how much premium they should cover under the policy, what should be the minimum standards that we should expect from the organizations. And again, if the industry can, as a whole, come up with standards and talk to and prepare sector-specific insurance policy to cover cyber, I think that would be one way to resolve these issues.
Thank you. John, do we have any questions?
Do we have any questions? We should have. Maybe cyber attack. Here we go. Systematic risks such as mass outages, business interruption, and prevention of access to technology could cause $1 trillion multi-day loss. These type of losses haven't been modelled. How would you encourage insurers to prepare? That's
well, actually, a fair increasing amount has been done in this space, driven by various market participants, right? So the prudential regulators are very big on this topic, not only to the insurers, but also to a lot of the financial institutions that are buying cyber insurance. They themselves are trying to understand what systemic risk looks like. You look at the recent stress testing done in Australia, certainly in Singapore, it's top of mind for the MAS, and I certainly know in terms of the prudential regulator in the UK as well. So I think a lot is done in this space. A lot is done by the insurers to understand what aggregation and accumulation exists. aggregation on the top cloud providers, accumulation in terms of things like we saw with NotPetya and WannaCry, where single event, common technologies, and then obviously systemic risk. So I think a lot has been done in this place, and if you look at various data points out of different providers, we're starting to put some numbers around it. It is in the trillions. One of the recent data points was, one of these systemic risks could cost, between $3 to $4 trillion in loss. Certainly, we did a piece of work recently that looked at large cloud providers being attacked could represent, 20% of clients being impacted by such a systemic risk. So I think a lot has been done in this place, and I think actually, again, to the role of the insurance market, bringing model into this as capital providers, draws a lot of focus around how to improve the management of systemic risk. That underwriting process on the front end is definitely driving a lot more visibility on it. And then on the back end, in terms of how do you put some reasonable exclusions for sort of war-related risks. I think we're not there yet, but we're definitely making much more advances in this particular space than we were 5 years ago.
Yeah, I think there's a divergence of beliefs that you can't quantify something that hasn't happened and there hasn't been a big event and all this kind of thing. So.
Yeah.
Well, I think a key point on this, though, David, is that this is very different from a lot of the things that the insurance market does normally. If you take an example, as you said, if you lose a big cloud provider, if you lose an AWS or something like that, even if it's just for a short time, the aggregation and accumulation risk on this is completely mind-blowing. Yeah. I mean, when I was at Cathay Pacific, we did a survey of all our suppliers, and it turned out that I think 70% of our suppliers were using AWS. We were using AWS. So when you have something that impacts a big vendor like that, that's going to go right across everything in your building, in the next building, in the building down the street, in the building in the next city, in the building on the city after that. Whereas for fire, it doesn't happen like that. It's not that 20 cities simultaneously all burn to the ground. That just doesn't happen. So this is just a very different risk, not impractical, not impossible to get our heads around, but it takes a very different approach from insurers than what they're traditionally used to dealing with.
One more?
Yeah,
maybe. One more question. The industry often looks at cyber as similar to property risk, which I said that from Steve. Quite different. With this in mind, how does the insurance industry attract and retain talent to indemnify insureds around cyber risks?
Can I just put some context to this question? I think what the person asking this question is saying, because I mentioned it to me earlier, is that when it comes to, this is about talent, right? When the industry looks at a cyber attack, they think about how do you put a property together again after it's been blown down, right? But a property already exists. A cyber, you can interdict and you can add things. You can get into the kill chain of this kind of thing. But when you restore, it's not just about cyber insurance, it's restoring that to what it was before. Where is the talent coming from? You don't have the plumbers and the builders. Is there enough talent to put it together again? All three of you can answer that, I think. The talent question is very important.
Yes, I think cybersecurity specialists, consultants are really in demand nowadays. And a lot of them actually can, have a, very, lucrative career by, advising companies on how they can, be more cyber resilient or help them managing cyber risk, incident response. So I guess in order to attract these cybersecurity professionals to join the industry, to help them to come up with more fit-for-purpose policies, I think would require definitely some sort of good remunerations to the talents, but also the overall recognition within an organization that these are specialists and they the recognition that the industry is really keen on expanding cyber insurance as a new area. I'm not sure whether this is correct or not, but based on a lot of articles that I have read, there seems to be a message showing that the industry as a whole actually is not interested in cyber insurance because of the risk and the cost involved. And some, people have, suggested that in a few years' time there will be no cyber insurance. So I guess definitely this kind of message in the market should be corrected, and recognition is very important to attract talents.
I'll be very brief. Look, I think, I don't want to say war on talent, I want to find a better word than that, but there is real challenges around attracting talent in this space, because clients, brokers, insurers, everyone are trying to find the same group of talent, and that's been recognised as well in terms of the second order implications of this when clients think about how they stand up the right incident response capabilities in the event that, to Steve's point, there is a systemic event within the financial services industry. What happens if you're the third company to call upon your preferred vendor and you find that they're now conflicted out because they run maximum capacity serving your competitors, helping them, remediate and resume after that same event. So, this is really top of mind at the moment. So, yeah.
Yeah, I think it's a big problem, because if you look at where a lot of us came from, I mean, my first qualification was mechanical electrical engineering, and then I did surveying and things like that. So I'm going to end up in the property industry somewhere. And it's not, as DPM Wong said this morning, the insurance industry is not that sexy. So you end up in that business, that's okay, it's fairly clear. But if I'm in the cyber sector and I've got the opportunity to go and work for Amazon or Google, and I've got the opportunity to go and work with Elon at Grok that he's just announced, whatever that might look like, why would I go and work for an insurance company? There's a huge gap there, and that gap, I don't know how we're going to cover that gap. But if we're going to be serious about cyber, we must deal with that.
Well, we're out of time, so thank you very much, the three of you.
Please thank the Cyber and Security panel. Thank you.